Hey there, welcome back to this channel. I'm Juliette, the creator of Concierge CPA. Today we're going to take a deep dive into the heart of accounting, the accounting equation. So sit back, relax, and let's get started. At its core, accounting is about recording and understanding the financial transactions of a business. The accounting equation, which is assets equals liabilities plus owner's equity, serves as the foundation for the entire accounting process. It reflects the fundamental concept of double entry bookkeeping, ensuring that the company's accounts are always balanced. Think of the accounting equation as a balance scale. On one side, we have assets, which are everything the company owns, like cash, accounts receivables, patents, investments, equipment, inventory, and goodwill. On the other side, we have liabilities and owner's equity. Liabilities represent what the company owes to third parties, such as loans, accounts payables, taxes payables, wages payables, accrued expenses, and so on. Owner's equity is the owner's interest in the business. Think of it as the residual value after liabilities are subtracted from the assets. Owner's equity includes owner's investment and retained earnings, giving them a claim on the business's net assets. Let's make it clearer with examples. If a company has $10,000 in assets, consisting of $7,000 in cash and $3,000 in equipment, and has a $4,000 loan, what is the owner's equity? Exactly, the equity is $6,000. Let's look at a real-world example. Let's take Apple, for example. Their balance sheet from 2022 showed total assets of $353 billion, total liabilities of $302 billion, and total equity of $51 billion. Can you see how the accounting equation holds? The accounting equation is a snapshot of a business's financial position at any given moment. As the business progresses, this equation remains balanced. The equation ensures that for every transaction, the impact on assets is mirrored by changes in liabilities or shareholders' equity. This balance helps businesses prepare reliable balance sheets and make informed decisions based on accurate financial information. When a company borrows money, both assets and liabilities increase. When a company earns revenue, it might increase assets and equity. When a company pays off debt, assets decrease, but so do liabilities. This equation shows us the cause and effect of business transactions. But there's more. The accounting equation can also be expanded to include revenues, expenses, and dividends. The accounting equation then is assets equals liabilities plus owner's equity plus revenue minus expenses minus dividends. This gives us even more insight into how transactions affect a business. Now let's see the accounting equation in action. Let's say you start your homemade cookie business with $5,000 of personal savings as your initial investment. The accounting equation would be assets, $5,000 cash, equals liabilities of 0 plus shareholders' equity of $5,000. When you start your homemade cookie business with $5,000 of personal savings as your initial investment, you contribute $5,000 as equity to the business. This increases the cash by $5,000 and the owner's equity by $5,000. The accounting equation is now balanced. You use $500 of your cash to purchase ingredients for baking cookies. Your cash goes down by $500 and your inventory goes up by $500. Again, the accounting equation remains balanced. You now have assets of $4,500 cash, $500 of inventory, which equals liabilities of 0 plus shareholders' equity of $5,000. You borrow $1,000 from a friend to expand your business. Your cash increases by $1,000 and your liability increases by $1,000 since you now owe the borrowed money. Your accounting equation now is assets, which includes $5,500 cash plus $500 in inventory, equals your liabilities of $1,000 from accounts payables plus shareholders' equity of $5,000. You sell cookies worth $2,000 to customers and receive cash payment. The cash increases by $2,000 while your revenue increases by $2,000. Your accounting equation now is assets, which includes $7,500 cash plus $500 in inventory, equals your liabilities of $1,000 plus shareholders' equity of $7,000. Now let's say you use $500 of your cash to pay for monthly utility bills. Your cash is decreased by $500 and your expenses increase by $500. Your accounting equation now is assets, which equals $7,000 cash plus $500 in inventory, equals your liabilities of $1,000 of accounts payables plus shareholders' equities of $6,500. Let's say your homemade cookie business purchases baking equipment for $1,000 but only pays $300 in cash, leaving a remaining balance of $700. This transaction will result in an increase to equipment for $1,000 and a decrease to cash for $300. However, since the full payment was not made, the transaction is not balanced, resulting in an imbalance of $700. An unbalanced transaction like this indicates an error in the accounting records, as the accounting equation must always be in balance to ensure accuracy in financial reporting. To correct this imbalance, you must record the remaining $700 owed to the seller of the equipment. Your accounts payable increases by $700 to reflect the amount you now owe. Now your accounting equation is balanced. It is important to identify and correct unbalanced transactions to maintain the integrity of the accounting records and financial statements. The use of trial balances and careful review of the accounting entries can help detect and rectify such imbalances before financial statements are prepared and finalized. So no matter how complex the transaction, the accounting equation ensures that the financial records are accurate and balanced. And that's all for today's video. I hope you have a newfound appreciation for the magic of the accounting equation. Don't forget to like, share, and subscribe for more accounting knowledge. Thank you for watching. See you next time.